Hi everyone, welcome to today's video. So on today's video, we are going to have a very honest conversation around the market crash, whether the markets are going to crash by December of this year. This is a very interesting question. Many of you have asked me to make a video yesterday about this. So here I am shooting this video, and I feel that the markets are not going to crash by December of this year. There are three specific reasons that I would want to discuss with you, and we are going to have a short discussion around how you should invest in this market. Please watch the video till the very end. Please press the like button. Please do it now. Helps with the YouTube algorithm. And please watch the video till the very end, because if you don't understand the entire concept, if you understand half my arguments, implement half the other things, it leads to bad stuff. Okay. So with that said, let's get the video started. And three reasons that I feel that the markets are not going to crash. Reason number one. First, the markets are going to consolidate. So let me put that in a more elaborate fashion today. So essentially, this is where the market currently is. If you take a look at it, we are sitting at 18,000 and there has been a massive run up. Now, usually in the market, you will see periods like these, right? These flat lines. These are all market consolidation lines, right? Market consolidation. So essentially, market can move in three ways, right? One is that it moves up, right? So this is what is happening here. Second is that it goes down. This was the 2020 crash. And third is that it moves sideways. Now, the interesting part is that almost 60 to 70% of the time, the market simply consolidates or it moves sideways, right? So this is a very important point for you to understand that in today's scenario, it's not going to happen that the markets rose first like this and then they came down crashing like this and then they go up like this and then they come down like this. This is very, very rare. This type of scenario is unlikely to play out. Now, why am I saying it? Because you might say that, okay, Akshat, great in intuition, great from a history point of view, but can you explain the logic behind it? Okay. So now here is a real life example as to sharp recovery, right? So this was 2020, right? When the corona crash happened, the market corrected. Now, why did the market fall by so much or so sharply? The answer was that no one knew what coronavirus was. This was an unprecedented event in the history of the mankind. No one knew how to react to it, what would be the scale of impact. So there was a lot of panic and the market corrected or fell sharply. Then why did it recover so sharply? Now, of course, in the hindsight, it's very easy to say that, you know what, the governments knew how to react to it. They had already built a game plan post 2008 that do quantitative easing and the markets will bounce back. So even if you assume the argument that, we could not have predicted this sharp recovery, we could have still assumed that the markets are going to correct at some point in time. It could have corrected. So this is how market corrected in actuality. There could have been also a scenario that the markets went down, then they consolidated for a long time and then they went up. Third scenario could be that, okay, market came down, then they consolidated, then they went up, then they consolidated again, then they went up. So no matter which graph do you see here, 1, 2 or 3, whichever option you pick, people who have been investing in the market, they knew for a fact that the markets are going to come up. Now we are in the opposite phase, that the markets have already run up, right? So this is completely diametrically opposite scenario to 2020 COVID scenario. Now here what is happening is that the markets have sharply increased. Now there are 2-3 scenarios, right? That it keeps on going up and up and up, right? It just does not fall at all. Second scenario is that it has gone up. Now it corrects very sharply, right? That's scenario number 2. And scenario number 3 is that it goes up, then it consolidates, then it moves up again, then it consolidates, then it moves up again. So which option do I feel is likely to play out? So in my opinion, number 3 scenario is likely to play out, that the markets are going to consolidate for a certain phase, then they are going to run up again, and then they are going to consolidate again, then they are going to run up again. Now, of course, I can make like an entire video on this topic, but to cut the long story short, this type of sharp downfall is unlikely to happen. Now, the biggest reason why this sharp downfall might happen is that if we again see some kind of an event that no one could have predicted, only then this type of a sharp fall would happen. There is a reason why people say that, the market corrections happen after 10 years, because there is always some kind of unprecedented event. Since 2020 COVID has just happened, it's unlikely. Statistically speaking, it's slightly unlikely that again there will be a sharp correction that will happen in the market. Now, why am I pushing for the fact that the consolidation will happen in the market? Now, multiple reasons, but the biggest reason why I feel that the markets are going to consolidate is called as tapering, right? Tapering, right? I have made a separate video on this. I will link it somewhere here. Please go and watch it. Super important video. Tapering simply means that all the liquidity that has been injected. So if you consider this to be the world, right? World map, a square box. So the governments across the world have injected a lot of money in the economy by printing more money, by buying bonds, all that stuff. So there is excess money that is flowing in the economy, and all the assets, be it stocks, be it real estate, be it bunch of different assets, their prices are being jacked up. Now, this slow tapering will happen. It means that the governments now will start withdrawing money from the economy. So as a result, the markets are going to undertake this consolidation phase, right? These are consolidation phases, and this could be one of the prominent reasons why the markets are going to consolidate. Now, the second reason why the market is not going to crash till December is the liquidity driven rally, right? So liquidity driven rally is related to what I was just explaining. Liquidity driven rally simply means that, hey, this square box, government put in a lot of money, right? It took the stock market up. Now the government is pulling out the money, right? That the government now will start withdrawing the money from the economy. But it's not as if that they will do it at such a rapid pace that, hey, okay, here are the markets going up and now we are pulling out the money, the markets will fall like this. Then what was the point of injecting all this liquidity, right? Now this does not make any sense because governments do not want to shock the market, right? There is just no way that they would want to shock the market. Governments, in fact, want to absorb the shock. For example, 2020 was a shock. It was a shock to the world. Governments came in, threw in a lot of money in the economy, tried to save that. Why? Because they were trying to act as shock absorbers. So that's a simple point, that this is a liquidity driven rally. Even if you assume that this is a liquidity driven rally, it does not mean, absolutely does not mean that the markets will go up, then they will fall down like this. No, absolutely not. Now comes the third and very interesting reason, which is around the IPO financing. Now, you must have seen that a lot of companies like Oyo, like Paytm, like Nykaa, like bunch of different companies, they are launching their IPOs very, very soon, right? Now, you need to understand a few key points. This is the most important section of this video, and please consider this from a knowledge point of view. I'm not trying to build contrarian theories here. This is all data backed, and I will show you some of the key points here. Now, let us first and foremost understand that whenever any kind of IPO comes out, you need to understand who the investors are in this IPO and who the stakeholders are, right? This is a very important point, who the stakeholders are. Who are the stakeholders? Now, if you take a look at the IPO for Paytm, right? Now, this is the shareholding pattern for Paytm, and you tell me if Paytm is an Indian company or a Chinese company, okay? So, Mr. Vijay Shekhar Sharma has a 14.67% stake in Paytm. Now, you have Softbank, which is a China-based firm. You have Ant Group, again, China-based firm, 30% and 20%. Right? So these are all FIIs, right? Foreign institutional investors in a way. They are private equity funds, to be precise. These companies have more stake in the IPOs compared to Indian investors. So you must have heard the term that in India, the stock market is moved by FIIs, foreign institutional investors, and DIIs, domestic institutional investors. Now, these are essentially big pocket players. They have a lot of money, lot of stake in Indian companies. For example, private equity. These FIIs are made by whom, right? These are made by private equity or VC funds, right? They are putting the money via the FII route into the Indian companies, so to say. And you can see these type of shareholding patterns being played out for a bunch of companies in India, right? So I will let you do that analysis. You tell me in the comment section whether that makes sense or not. So what did we learn so far? That, hey, the IPO market is essentially has a lot of stake from foreign institutional level players, FIIs, right? Very, very important party. This is where the smart money is. They invest a lot of money and they are after what? They are after returns, right? Returns. And all these big players make returns one way or the other. Now, since we understand that these FIIs have a very big stake in the Indian IPO market right now, you need to understand how they are invested in the startup space. So, for example, when any of these big players, for example, if you take a look at Oyo or if you take a look at Zomato, right? All these different companies, how did they raise funding? So, initially what happens is that this is a startup, right? They are very small. They have just started building traction in the market. So, you will have different VC funds or PE funds, right? They put in money. For example, I showed you the example of Softbank. Now, Softbank does private equity VC deals. So, what they would do is they would give money to Oyo and they will say that, you know what, we are going to own like X% stake in your company. Here is like your Series A funding. Then there is Series B, C, D, and E. And these startups keep on taking more and more money from different investors like Ant Group or Softbanks. Now, till this point, the story is very clear that, hey, you have like these big pocket players. They are putting money in Oyo, Zomato, etc. Zomato are not making money, then how are these big guys getting money at the end? What is allowing them to make money and keep on making such investments in the future? They must be making the money somewhere, right? Okay, so here is a short paragraph for you to zoom in and read. This explains the entire concept behind how investors make money. I will also take you through some of the finer points here. So essentially, these private investors, for example, when Oyo started as a startup or when Zomato started as a startup, these big players come in, they do equity financing, right? Again, separate video altogether, but bottom line is that these Oyo, Zomato, bunch of different companies are getting money from big ticket investors. So let's say that Softbank has invested money in Paytm. Now, how does Softbank gets an exit, right? So exit means that how is it that Softbank is able to get out of this investment? Now, there are two ways in which they can do it. Route number one is very simple, that hey, find like other private equity funds, right? Other private equity funds. Sell them your equity. So let's assume that Softbank gave Paytm, let's say $50 million. They said that, hey, we are going to take like 50% of your company. Great. Things kept on moving. Paytm kept on raising more and more and more money. Eventually its valuation, right? Valuation became very high. That at the time when Softbank made the investment, let's assume that Paytm valuation was $1 billion. Now it has become $2 billion, right? So Softbank has technically made money on this investment, but how is it going to encash that money? So they need to go and sell their equity to other private equity funds, right? Now the issue with especially loss-making businesses is where you are not seeing the real money, you are just betting on growth potential. No one knows how to value it. And this is what is said on this particular paragraph. And I will ask my editor to underline this. So it says that private investors can do this in two ways. Try and sell equity to other PE, private investors, or sell equity to public. Often it is hard to find an interested private investor and terms are not that great. This is because there is no way to know how much money is valued by the public market. Other private investors are interested in marketing sizable profits in short period, thus bringing down the offer price. So essentially, to cut the long story short, if Softbank has to make money, they have to go and find another private investor who can buy their equity. Now these deals are super big, right? It's not easy to go and sell this equity to someone. It's usually not an all cash deal, right? That it's not as if that Softbank will go. They'll say that, hey, give us like $100 million of cash and they'll get it. No, it's super difficult to do that. Therefore, to get a better deal, these private investors might want the company to go public. Going public means that an IPO is launched and then you as a retail investor make the decision to invest. When you end up buying a stock, that is when a company like Softbank is offloading their equity on you in a way. Is this good? Is this bad? Separate discussion altogether, because there are good IPOs also, there are bad IPOs also. I'm not trying to criticize any firm as of now. I'm just trying to show you how IPO financing actually works. Because people get super excited that, you know what, we are going to invest our money in an IPO. Do it, but do it sensibly. Now, here are some other key important points. Let me quickly take you through it and then I'll explain you why is it that the market might not crash till December. Okay. So an IPO gives private investors an exit route. We understood what this means. The lock-in period in which private investors can't sell their share, it ranges from 3 to 24 months. And there is a reason behind it. For example, there is any company, let's call it Z with red color. You can guess the company name. So let's say that it launches its IPO, right? It gets listed at like 120 rupees, right? Then what you will see is that, for a few days that the stock price will climb, right? Till it will go to 150. And at this point in time, the existing investors, for example, Softbank or any other company, they will sell a little bit of their shares, like let's say 5% of their shares. And this will lead to a fall in price, right? So it will go up to 130. Then it will go up again to 150. Then they will sell like 5% more. Then it will again fall back to like 120. Then they will sell like 5% more, bring the prices up. Why does this seesaw dance happen? Why is it that, first go up, then go down, then go up, go down? Why? Because if a company like Softbank or a major investor starts offloading the shares, the stock price will fall like this, right, in one go. Even their money will not get recovered because the volume is so high, right, that if they own like, let's say 40% of the company and if they sell 40% of the stocks, bad stuff will happen to the price. Now, this is elaborated by a concept called flipping, right? So I will put a paragraph here. Just go and read it. This will help you understand more about what flipping actually means and how it works in an IPO. Now, why am I saying that the markets are unlikely to fall in December? One very big reason is that right now India is a hot market for IPOs. Lot of new IPOs are being launched and a lot of big ticket investor money is stuck with these IPOs. They also need an exit. So for example, here are a bunch of companies that are going to launch their IPOs. Paytm is there, MobiWik is there, There's like companies like Shriram Properties, there is Keventers, there is Bajaj Energy, Policy Bazaar, Nykaa. You can go through this entire list. Huge names, right? Almost all these big companies have very big FIIs backing them. Their money is stuck. If the stock market falls right now, let's say that if it says that if it falls from let's say 18,000 to 15,000, do you think that people will be so excited about investing in IPOs? You tell me, right? You tell me in the comment box that would you not be scared that, you know what, okay, fall has happened. If I go and invest my money in this IPO, what would happen then? I'm scared. I'm not going to do that. Therefore, no major correction is going to happen till December. That is my take. Now, this brings us to the question that, hey, Akshat, okay, since December, you're saying that the markets will not crash. So should we go and invest our money in all these IPOs? The short answer is no. You should not invest your money in all these IPOs. You must be able to identify good IPOs versus bad IPOs and do not get stuck, because it might very well happen, hypothetically speaking, that till December everything is good. You invest your money in some IPO, it gives you initial gains also. Then investors at the back end start taking exit, market also falls, then you're stuck with some bad product that you can't even sell, right? So please don't let that situation happen. I will explain this by showing you the examples of 2 IPOs that are going to be launched. Now this is regarding the finance data from 2 different companies. I've already made a video on one of the companies. Again, please note that this is not a buying or selling or like investing recommendations. I'm just doing it purely from an educational perspective. Go and invest. You might make a lot of gains. I don't know. That's a due diligence that you will have to do. Okay, so let me show you the matrix for OYO. Now these are the returns, right? So financial year 19, 20, 21. It's a loss-making company. Operating cash flow has been consistently negative. The more they sell, the more losses they make, right? To me, this business as an investor does not make sense, and I'm not going to invest a penny in it, right? At least read this basic data in the prospectus, because majority of the retail investors, what they do is that, okay, you know what, okay, I've heard of this company, IPO is coming, everyone is going to buy it, let me also buy it. So don't go by that, right? At least use like little bit of brain and logic here. Okay. Now let me show you the second number, right? Now this is the Policy Bazaar data. Now here you can see that at least the premiums are going up, right? For example, you can see that the premiums are going up, right? So at least their sales are increasing in some capacity. With the previous data, if I show you the graph, you will see that even the sales have come down, right? From financial year 19, the total sales or income was 6518. Now in 21, the total sales is 4157. In percentage term, the loss has in fact gone up. This is a fixed cost business. They are not even able to sell units right now. Okay. With Policy Bazaar, at least the sales are there. So that's one. Now let's look at the adjusted EBITDA, right? That means that the losses. Now Policy Bazaar is a company where they are selling more units and they are getting more operationally cost efficient. For example, in 21, they made a loss of 615 crores, right? But in 2019, they had a loss of 2800 crores. So at least this bottom line is improving with improvement in sales. Now, is it a buying recommendation for Policy Bazaar? No, I'm not saying anything. I'll probably do a separate video on that. But a lot of people start commenting that, hey, Akshat, you criticize like all the IPOs. No, I have not done that, right? There are companies where the business made sense to me. I gave like favorable reviews. So it's not possible for me to do an entire IPO analysis of different companies, but I just wanted to present a very broad picture as to how you yourself can do this basic analysis at least, right? So please do that. Please don't jump the gun and start investing your hard-earned money in instruments where you might get stuck. I'm not saying that all these IPOs will not help you make money. They might not, but at least as a rational investor, do some basic analysis. Okay. Which brings us to the final part of the video, that if the market is not going to crash, what is it that you must do? Number 1, please hold quality stocks because the markets are going to consolidate at some stage. Understand sector rotation. Yesterday I had made a video. Please go and watch it. Super important video from that perspective. Please watch it. That's 2. Third, please discard stocks that have poor financials, poor management, bunch of different problems going on. If they can't survive even on an upswing when the markets are going up, of course they are going to tank badly when the markets go down. That's 3. Fourth, the IPO game. Please do your due diligence and invest. These are my personal recommendations and opinions. You as a rational, sensible investor can have different contrarian opinions and we can both be right. Thank you so much for watching the video and I will see you the next time.